No,
You're
no.
not. Facebook's up. YouTube's up. Ready?
Yeah.
3, 2.
I get asked the same 3 questions almost every day. Question number 1, is it a good time to buy a house or should I wait? Question number 2, when should I lock my interest rates or when are interest rates coming down? And number 3, how do I avoid monthly private mortgage insurance with less than 20% down? Or I bought a home with an FHA. When can I get rid of my monthly PMI? Tonight, I'm going to go over one of the most powerful tools in home ownership that will save you thousands on thousands of dollars. What's going on, guys? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. If it's your first time tuning in, do me a huge favor, hit that subscribe or notification button so you're notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 9 p.m. Tuesdays at 8 p.m. on TikTok and 9 p.m. on Instagram. We also post daily content and tips on Instagram and TikTok. So go ahead and follow us on our other platforms. Also, guys, this is an interactive channel, so ask a lot of questions. And if this video brings you any benefit, please like the video. And last but not least, if you know anyone who is interested in our content, please tag them on this video. All right, guys? So tonight, we are going to talk about how to avoid monthly PMI with less than 20% equity. Okay, how to avoid monthly PMI with less than 20% equity, which is a question people ask every week, especially Tuesdays when we have our Q&A Tuesdays on our Instagram story. I get this question like pretty much 5-6 times in one day. So we're gonna go over it. But first, we need to understand what is PMI. For those of you who don't understand what PMI is. What is PMI? PMI is private mortgage insurance, insurance that protects the lender in case a homeowner defaults on their loan. When a home buyer puts less than 20% down on a conventional loan, it costs about 13% to foreclose on a property. But people say, but if I put more than 7% down, why is there still PMI? Because of the cost of opportunity that lenders lose out when they lend you the money. So imagine this. If you had to loan out money to somebody and they put minimal collateral, wouldn't you make them get insurance to make sure you get your money back? Also, if you wasted all your time and energy to loan them the money and they can't pay you back, you could have lent the money to someone else. So you want to make a little bit of money on that. So that's what these banks do. They charge you mortgage insurance to protect themselves in case you can't make your mortgage payment. It's important for you to know that because some people think that PMI is a JIP. It is actually not a JIP. It actually generates and creates an opportunity for you to buy a home without saving 20% down. If most Americans had to save 20% down to buy a home values would probably be lower, but people would take forever to save the 20% down. So be very thankful that mortgage insurance is available for you to buy a home with less than 20% down. Okay, hopefully you understand it. So let's go over monthly PMI. That's what people don't like. So this is on conventional loan. On FHA loan is called something else, right? On FHA is called MIP, mortgage insurance premium. On conventional, it's called MIP, right? Or monthly mortgage insurance. So how does monthly mortgage insurance work? You pay a monthly fee each month to cover your insurance until you either pay down the house 20 to 22% from the original purchase price. Remember, this is conventional loans only. FHA, it is permanent unless you put 10% down or more when you buy. Then on the 11th year, it falls off, okay? So, example, if you bought a home with a conventional loan at $600,000 until the balance is $480,000 or $468,000, then the lender will remove the PMI when you call it in. Or number two, if you gain 25% equity after 2 years, you can have your lender order an appraisal, or they do something called BPO, broker price opinion, and they will remove your PMI once they validate that you have the equity. So let's talk about the first one again. So it's 20 to 22% from the original purchase price on a conventional loan. So if you pay it down 20%, so on that 600,000, you pay it down to 480, you would call your servicer and they will remove your monthly PMI. Or if you pay down to 22%, right here on 600 grand, it's 468,000, then it will fall off automatically. Well, who's going to wait till 468? I want it gone right away. Then you would call it at 20. The number two, this is the tricky one that everyone has misconceptions about. So the rule is if you put 5% down or 3% down, once you gain 25% equity after 2 years, you can call your servicer. They'll do an appraisal or BPO, broker price opinion. And if you have the equity, they will remove your PMI. But what happens if you put 10% down or 15% down? Every lender has their different interpretation. Typically, if you put 10% down, they might wait for you to have 20% equity in 2 years or maybe less. 15% down, it's 20% equity, maybe in a year. It all depends. So call your servicer so you have an exact answer when they will remove your monthly PMI. Okay. So, of course, this is what everyone wants to avoid. Now we know how to get rid of monthly, and no one wants to wait it out, right? Especially with inflation pushing up, everyone's trying to get as much cash flow as possible. So now we're going to talk about the most powerful tool in home ownership. You can do this to buy a house, but also you can do this to refinance a house. This strategy comes in, it comes in good. It works well when you have an FHA loan. Instead of going from FHA to conventional and having monthly PMI because you don't have the 20% equity, or keep your FHA loan until you have the 20% equity. If you have enough equity to do single premium on an FHA loan, you can refinance from FHA to conventional without 20% equity and not have monthly PMI. Okay. Also, when you buy a home, less than 20% down, now you have more cash flow. Okay. Let's talk about single premium private mortgage insurance. How does it work? Instead of paying a monthly fee for private mortgage insurance, you can pay it all up at once and eliminate paying monthly for PMI. So it's a one-time bill, boom, you're done, right? Who pays for it? Buyer can buy it, pay for it. The lender can pay for it. The seller can pay for it, or everyone can contribute to pay for this single premium PMI. So right now, you can either come out of pocket, pay for it if you want. The lender can pay for it. Typically, if a lender is paying for it, you have to take a higher rate to cover it. And this is where another nugget for you guys. Sometimes on traditional loans, like conventional loans, that's pretty much on conventional loans. Mortgage brokers, small direct lenders have better interest rates than the bigger banks. So let's say you took a loan from the bigger bank. They gave you a specific rate. You'd have to pay that rate and then pay your monthly PMI. But because some of these brokers or smaller lenders have lower rates because they don't have all that overhead, they can give you the same rate as these bigger mortgage banks, but can cover your PMI. That's how high you're paying in rate when it comes to getting a mortgage on a conventional loan, when you're comparing a big mortgage bank or a brick and mortar bank to a small direct lender or a mortgage broker. So you might want to check that out. But yes, the lender can pay for it. Typically, they will increase the interest rate. But here's a way for them not to do it where, hey, this is why I would go this route, small direct lender, broker on conventional loans. The big banks, they will blow you out of the water when it comes to jumbo and ARM loans. Just keeping it 100 with you guys, okay? Of course, last year, before COVID, when times are different flavor, different time. Right now, the time is, these brokers, direct lenders, They squash these bigger banks when it comes to conventional FHA loans, VA loans, right? Other programs might be different. Hopefully that helps you out. So you can either have the lender cover or seller. As the market is softening, you can use that speculated equity, right? When I say speculated equity, the last comparable sale is keeping the value up because someone overbid on that property and that home sold and that last comparable sale pushed up the value. Find out what you can buy the house at. You can use the seller speculated equity or just have the seller, hey, cover this. For me to buy your house, I need you to buy out my PMI with single premium. Make sure you work with a real estate and a lender that's communicating so you can go ahead and get that PMI removed one time, right? Or, you find out the cost, the buyer chips in, the lender chips in, the seller chips in, and then you don't have to stress about it anymore, okay? So single premium is a great thing. You have to understand how it works and then figure out who's chipping in, right? You ever go out somewhere and a bill comes out and everyone just like looks away? When this bill comes out, like who's got in on this, right? Who's chipping in? Are we splitting this 3 ways, 2 ways? How, figure that out. But of course, how do you figure that out? You got to figure out how much it costs first. So let's talk about what is the cost of single premium. To figure out the cost of single premium, you want to know the credit score, the middle credit score of the lowest person if it's more than one person, the loan to value, right? The higher the loan to value, the higher the cost. Occupancy, property type, debt to income ratio before PMI, right? And then last but not least, how many borrowers are on the loan? Okay, so if, of course, the higher the credit, the cheaper the single premium is going to be. The lower the LTV, let's say 15% down, it'll be cheaper than 3% down. Occupancy, of course, owner occupied will be cheaper than second home or investment. Property type, single family home and condo will be cheaper than manufactured home or multi-units, right? And then DTI, this is the debt to income ratio before PMI. And then, of course, when there's 2 borrowers on the loan, you are a lower risk than 1 borrower. In case if you only have 1 borrower and that person loses their job, you have no income, so you are higher risk. But the crazy thing is this: if you have 2 borrowers on the loan with good credit, but only 1 borrower has a job and the other one doesn't, the PMI is still cheaper because you have 2 borrowers on the loan. Sometimes I'll win loans from other lenders when I know it's a conventional loan and they're married, but only the main person's on the loan. I'll throw in the spouse and boom, get cheaper monthly PMI. So there's different strategies. That's why you want to work with someone that's chasing the cheapest mortgage payment for you. End of the day, you are making that payment. You want to work with someone who cares about your payment. Okay. So now let's look at the single premium PMI chart. You can download this chart yourself. You can Google MGIC rate card, RATE card, or I left you the link on the bottom of this PDF. But this is what it looks like. Okay. Credit scores on top, LTV on the left, right? And then, of course, there's a second home. If there's a relocation, manufactured, 3-unit or 4-unit. If you're doing lender paid premium, declining renewal, right? Over 45% DTI, 2 borrowers or more. So all the adjustments are on here. So when you want to figure out single premium, look on there. Also, there's coverage 30%, 25 or less. I always go with the 30% in case you run DU, you don't get the 25. I always assume worst case scenario. You run DU, the desktop underwriting software, it might go 25% coverage. Let's say you have that 760, 780. It might go 25% coverage. Boom, it's even cheaper for you. But I always assume the worst. Okay, so here's a chart, and now we're going to show you how to calculate it. Okay, so of course, my beloved scenario: 740 credit score, single family home, 5% down, 2 borrowers on the loan, and the DTI is under 45%. Of course, if you want to go over this, you want to get a loan estimate from our team and our company, or you want me to help you shop for a better deal and find you a better, cheaper single premium or monthly, go ahead and give us a call, 714-790-9697. You can email us, email at whatsamortgage.com. If you have a loan estimate, send it over to review@whatsamortgage.com, and we'll Go out there and try to find you the best deal and the cheapest single premium PMI. Okay, now let's get back to it. Thank you, Andy. I know that was off the cuff. So 740 credit score, boom, we go to the 740 section. Okay, 5% down, boom, we go to the 5% section. And then, of course, the 30% coverage, it's 1.73 is our base cost for single premium. Now we got to add all the adjustments, okay? You can see it better on once you open up the link. So it's not a second home, so there's no add-on. It's not a relocation, not a manufactured home. We look at the 740 section, right? It's not a 3-unit or 4-unit. And the DTI is under 45, so I don't need to add anything on. See how there's 2 borrowers on there? So I get to subtract 0.14. So if my base rate was 1.73 and I want to subtract 0.14, the cost for single premium private mortgage insurance is 1.59%. All right, so 1.59% is the cost of single premium. So now let's figure out how we calculate it. So it's calculated against the loan amount. So on a $500,000 home, 5% down, it would make my loan amount $475,000. With single premium being 1.59, the total cost to buy out my monthly PMI, right? So I don't have to have monthly, $7,552.50. So either you can pay for this out of pocket, or you can have the seller pay for it, or have the lender increase the rate a little bit and cover it. It all depends. You know, if you want help, definitely reach out to us. So on a $500,000 home, instead of putting $100,000 down to avoid monthly PMI, you can put $25,000 down to avoid monthly PMI. You just got to pay the cost, $75.52, right? So I bought my house in 2020. My monthly PMI was $460 a month. I paid single premium. The reason why my wife wanted to, she wanted certainty. So single premium is not for everybody. She had in her gut feeling that, hey, we might not gain 25% equity, right? With the lender we went with, we put 10% down, but they still wanted us to wait 25% equity after 2 years to remove the monthly PMI. Lo and behold, 2 years went by, the market has flattened out. We did not gain our 25% equity. Right, we're chilling in that 20, but now the 2 years up, it is cheaper that we paid for it up front and not worry about it monthly. So if values do dip, I don't have to worry about monthly PMI. Of course, as inflation pushes up, I don't have that $460 a month bill anymore. But some of you guys might buy a home, you might hit the jackpot, and there's tons of equity, and after 2 years, right, you have the 25% equity, it pays off. Or you're making money, you hit the jackpot, you pay down your house 20 to 22%. Typically, it takes about 7 to 8 years to pay it down. If you want to go by just monthly mortgage payment, you can look at your amortization schedule and see that. So it's not for everybody. I love single premium for myself. If you already own a home, if you have 5% equity, you 7% equity, you can do single premium and remove your PMI. If you have an FHA loan, you want to go conventional. If you have 10% equity, which I like the most, it costs you about 1% depending on the credit, right? The 2% depending on the credit, the 10% depending on the credit. You have the sheet there, and you can go ahead and look at it. If you bought your home probably from February up until probably June or July, you're still gaining equity. You might not gain the equity you were before, 2021, but homes are still going up in value. So maybe next year, the following year, if you have an FHA loan, you might not have 20% equity. You don't want to wait forever to refinance it. You might want to go sooner or later. Here's a way for you to do it without dealing with monthly PMI. You can go single premium. So this single premium tool works great from FHA to conventional and works great for conventional buying with less than 20% down. It creates more cash flow so you can move on your pace to gaining more equity, paying down your house the next part of your life. You don't want your whole life to be consumed by your mortgage. And sometimes that PMI consumes a lot of people. And I believe it. The reason why, viewers who've been watching me for years, probably every couple months, they keep sending me a message, even though they know the answer. Can I remove my PMI yet? Can I remove my PMI yet? Can I remove my MIP yet? Can I, over and over again. And that's why I wanted to talk about it tonight, So you have the knowledge and you understand this powerful tool on how to get rid of monthly PMI. Hopefully you found this video useful. If you did, do me a huge favor, like this video and share it. Tag a family member friend who has a mortgage with PMI or an FHA loan. All right, guys. Also, if you still want help trying to figure out how do I buy a home and not have monthly, or how do I go from FHA conventional, please give us a call or send us a text message, 714-790-9697. And if you have mortgage questions, bring it on. Let's get in some Q&A here, right? Hopefully I brought you guys some value tonight. Thank you, guys. How was tonight, Andy? Good? Wish it was always like that?
Yeah, you enunciated pretty well.
Yeah. What up, Ralph? How you doing? Giovanni was good. Omar Malgado was good. You have an awesome team helping me right now. Oh, awesome, RL07. So I really appreciate all you guys who comment and engage. I want to make sure that we go out of our way on our channel to bring you value. You know, I see a lot of people, they're funny on the internet. I try to be funny as well, but I think value is important. End of the day, when you strip away all the humor, all the algorithm information, all the algorithm to trick the system, you want to work with someone who cares about your payment, who cares about what you're doing next with homeownership. All right. Adrian, hi, man. Would like to hear more info. My current situation is an 800 credit score, $33,000 save, $125,000 in income. Okay. So let's bring up the Techie Lender calculator. We'll do one today. So Adrian Chavez, we will try to do one for you right now. Brian Young, what's good, fam? Brian Young is always messing me, man. Brian Young is a funny guy. What's good, Brian? Christy, what's going on? So, without debt, Adrian Chavez. All right, we're gonna do this without debt.
Let me
Okay.
switch it.
Okay, we're waiting for Andy to switch it over. We're doing one scenario tonight. Remember, Thursday's a scenario day on our Instagram. So send us your scenario. But of course, you asked Adrian. I want to make sure I do this for you. Is this it?
Almost. I'm trying to resize it.
He's going to resize it, Adrian. All right, here we go. So you can go to techielender.com, TECHY lender.com. Let's make it a little bit bigger. See here. How you guys doing tonight? You guys having a good night? It's crazy times right now.
All right, go for it.
Okay, let's go here. If you have $33,000 saved, we'll go conventional. We'll go no debt. See, $33,000 saved. We'll scroll to the bottom. Qualifier. We'll do 43% DTI. Annual gross. 125 grand a year. Zero debts. Right? Zero debts. In the bank account, we got $33,000. Here, let me take out that extra zero. $33,000. Single family home, probably $500,000. Interest rate right now, 5.375, 3% down. The monthly PMI is probably 0.53 with a 740 FICO score, hopefully. If we do monthly, the payment is going to be $35.23. Total out of pocket, $25,000. Adrian, let me see if you have enough here. We'll scroll down. Yes, it's all green, so you are good to go, right? So the total monthly mortgage payment is $35.34. If it was me, Adrian, I would find a way to get the seller to cover that PMI, which I know you can right now. You can get the seller to cover it. It's going to be, let's see here, it's going to be $33.20. Okay, so you have $25,000 you're using out of your $33,000. If you want to increase the amount, you can go up. Let's see, let's go up to, let's see, 550. At 550, right? Total out of pocket, $27,500, $36.52. So 3652. Let's see here. Ooh, way too much money. You are still good to go. You're available. $825 left. If you want to go above 550, Adrian, we scroll up. We put it down to 600,000. At 600,000, your total out of pocket would be 30,000. So you have $3,000 left. Total mortgage payment $39.84. Of course, you still qualify. You're at 38% debt to income ratio. So hopefully that helps you out, Adrian. So your total scenario one more time. On a $600,000 purchase, 3% down. Loan amount is $582. Interest rate is 5.373. APR for all the haters out there, right? All the trolls who want to throw some hate, 5.563. $30,000 out of pocket. There's no monthly PMI on this. I'm believing we can get the seller to cover it right now. Your total mortgage payment, principal, interest, tax, insurance is $39.84. So that's your total payment on a $600,000 purchase right now. Hopefully this information helps you out. All right. So I think that's all the questions that we have for today. I really appreciate everyone who followed our page, who liked, who commented, and who shared. And we want to end all our episodes with our attitude is gratitude. Without you, there is no us. So thank you guys so much and have a great